Okay. So going to proceed with your notes here. Hopefully that you already read Dr. Kamaru's notes here. So I just want to explain a little bit. Now, I'm not going to go in details about the types that you have in Dr. Kamaru. Just want to focus on the examples only. Explanations on the examples. Okay, so I'm going to continue with this one. Okay, so you have a note with you, isn't it? Now, that one. Okay, so you have a notes here. So we're going to proceed with the notes. Dr. Kamaru's notes. I'm going to, for the next class, is a new topic. So, okay, you've got that. So hopefully they were able to finish this one. Actually, not much more this one. Okay, so we're going to look at here for Dr. Kamaru's note on the financial instrument. We're going to look at the examples given here. Okay, so the things a little bit on the explanations that we have here in the first parts of the notes. Okay, so to look at here. So I need to do this one. Okay, so we're going to look at the things that you have for introduction parts here is about the financial asset. Okay, for financial asset, according to the standards here, for the financial asset, which is MFRS 9, so we have three categories of financial assets. Okay, the one that you have here, either that one is at amortized cost type. So this is a type of financial asset. Amortized cost, fair value through profit or loss. Okay, through profit or loss. And then the other one is fair value through under the others comprehensive income. So we have the three types of the financial asset. Okay, these financial assets normally we're going to use financial asset as financial liability going to be used as a hedging items. Okay, so I'm going to discuss about this one. Just want to know the types of what you have for the financial assets. Okay, so we're going to look at here for the financial assets here in this topic. Okay, we're going to discuss investment in a derivative instrument. So derivative instrument is a part of your financial assets. Another example of your financial assets. Okay, that one is a derivative instrument. Okay, so we're going to look at a derivative instrument. This derivative instrument is your financial instrument. Okay, so derivative is a financial instrument. It's defined by the MFRS 9 as having the following characteristic. Okay, the first characteristic here is a value derived from the value of one underlying asset, such as commodity, currency, bond or stock. Is required no initial investment. The second criteria. And then the third criteria here, it will be settled in a future date. Example for derivative here, you have forward, future, option, and swap. Okay, so this is what you have. Example for a derivative here. So we're going to look at for a forward contract is a customized contract between two parties to buy or sell an asset. Okay, to buy contract, forward contract here. Okay, for a forward contract here is a contract between two parties. Okay, between two parties that we have here. Okay, a contract between two parties. Okay, two parties to buy or sell an asset at agreed price on a specific date in the future. Okay, so this is examples here on forward contract. A customized contract between two parties to buy or sell an asset at agreed price on a specific date in the future. Okay, suppose that on 1st of January 2019, ABC you expect to purchase 1,000 tons of palm oil on 1st of April 2019. So ABC is exposed to the price fluctuation risk because it may hedge against the risk by entering into a palm oil forward contract to purchase 1,000 tons of palm oil at a future date at a specific price. Assume that the price of palm oil forward contract maturing on 1st of April 2019 is 1951. 1951. This is your forward contract. So the forward contract value here is 1951 per tons. On the forward contract lock in the price at 1951 when the ABC purchased the palm oil on 1st of April 2019. Therefore, ABC agree on 1st of January 2019 to purchase 1,000 tons of palm oil at the price of 19151, and 1951 here is this price time with 1,000 tons, so the value that you have here is 1951, on 1st of April 2019. So you sign the contract on 1st of January, going to buy, to buy on 1st of April, so at the price of 1951. If the palm oil price goes up, if the price is more than 1951, then the forward contract is going to have a gain. But if the price is lower than 1951, then the forward contract going to have a loss. So because you are in the positions of buying, if the price of the palm oil increase, you're going to have a gain. So if the price is lower than the contract price, then you're going to have a loss. A forward contract may be settled by a physical delivery or cash settlement. For the forward contract here, we have two types of settlements here. The forward contract, either you're going to settle that one with a physical delivery, and then the other one is a cash settlement. Cash settlement. If the forward contract is settled by a physical delivery, the seller is required to deliver the asset to the buyer at the settlement date, and the buyer make a payment as agreed in the contract. If the forward contract is settled by cash settlement, the asset is never delivered. The asset is never delivered to the buyer. Instead, the payment is made to the settler at the settlement date, the value of the forward contract only. If you choose for the cash settlement, you only settle for a forward contract. If there is a physical delivery, you're going to settle two items. You're going to settle for the forward contract. At the same time, you need to buy the asset, buy or sell the assets. So two things that you have if that one is a relate with a physical delivery. So you want to buy, you're going to buy for a physical delivery, you're going to buy the assets or the assets here, or settle the liability, and then you're going to settle the forward contract. But if that one is only for the cash settlements, we only settle for a forward contract. The amount of payment is a difference between the current market price and the agreed contract price. The amount of settlements here is a difference between market price minus a agreed contract price. Assume that the current market price for the palm oil on 1st of January 2019 is 2010. So 2010, if you look at here, the market value here is 2010. The contract price here, or the forward price here that you have here is 1951. So in this case, your market value is higher than the contract price, the forward contract. So means that you're going to have a profit. So profit for a forward contract will be your asset. So we're going to report that one as your asset. So in this case, the ABC is going to make a profit of 59. 59 here is a difference between 2010 minus 1951 is the contract price time with 1,000 tons. For the cash settlements here, ABC get paid cash of 59 for a profit. For the cash settlements here, for the cash settlements, journal entries here, you only get a profit of 59. You get a profit of 59. For the cash settlement, cash settlements, you're going to get a cash of 59. Where this cash come from? This cash is come from the changes in the value of the forwards. Changes in the value of forward. So the changes in the value of the forwards that you have here is this amount. 2010 minus 19151. So you're going to time this one with 1,000. So you're going to have here 59,000. The 59,000 is the cash that you're going to receive for the settlements of the forward contract. If you have any question, you can raise a voice up, or you can put it in the chat box. And then the next one, you have a future contract. Future contract is similar to a forward contract as both involve the agreements. So you need to have agreements. to buy or to sell an asset at an agreed price in a specific date in the future. The difference are that the future contract are standardized, and then traded over on the future exchange contract traded over the counter, while the forward contract is settled at the end of the contract. Future contract are settled on the daily basis until the end of the contract. This is in terms of the value of the contract. If that one is a forward contract, you're going to determine the value at the date you sign the contract or at the maturity date. But the forward contract, the value is going to be measured or maybe going to be settled daily. Yeah? Okay, and then the other ones you have the option. Option is a contract that gives the right to the holder. Right only, right to the holder, not the obligations to buy or sell an asset at a specific price within a period of time. Yeah? The specific price here is called as a strike price. Okay, for the option price here, price of options that we for the options here we call as a strike price. Okay, strike price or a options exercise price. Okay, exercise price or a strike price. Okay, within a periods of time, the specific price is called as a strike price or exercise price if the price of the option will be executed if the holders of the option decide to exercise the option. So once you're going to exercise the option, then you're going to execute the price of the option. There are two types of option. We have a call option and we have the put option. The call option give the holders the options to buy but not the obligations, a specific amount of underlying asset at a predetermined price within a specific periods of time. Yeah? Okay, this one is options here. Call option is options to buy, not an obligation. Yeah? Okay, the put options here give the holder the option to sell but not the obligation, a specific amount of underlying asset at a predetermined price within a period of time. The purchaser of the option must pay for the options premium. So this is what we said that the difference with the option and others derivative here. For the option, we need to make a certain amount initial outlay. You need to pay for the options here, and then these options payments that you use to buy for the options we call as a premiums. Okay, for the premiums here, we have two value here. Okay, for the premium, there is intrinsic value and the time value. Yeah? For the intrinsic value, an option is equal to the difference between the market price of the asset and the strike price. Okay, this one is a difference between market value of the shares of the assets here, of asset minus a strike price or exercise price of the option. If the amount to be realized by the option holder, it is the amount to be realized by the option holder when the option is exercised. If the market price of the asset is RM1 and the strike price of the call option is a right to purchase it is 0.85. Okay, let's say market value here is RM1. The call option is 0.85. So the intrinsic value here will be 0.15. This is your intrinsic value. Okay. And then if the market price of the asset is RM1, the put options, the right is a strike price of RM1 unless has an intrinsic value of 0. Okay, let's say if the market value is RM1 and then the option price, okay, the option price here is RM1, okay, also RM1. Okay, and then we said that the intrinsic value is 0, and then we said that or less, RM1 or less here. RM1, let's say 0.9 cent. So it's considered as a 0 also because this one, your exercise price here, you want to buy at the price of RM1. So if you want to buy at the price of RM1, let's say the market value of the share is lower than RM1 here, means that it's not worth to exercise your options. Okay. So the intrinsic value will be 0. Okay. Let's say the share price here, sorry about this one. Okay, again about this one, sorry. Okay, let's say your intrinsic value here is, so the market value here is RM1 And then the options here is also 1 ringgit. So we're going to look at here, the intrinsic value here will be 0 because this one is minus this one. Okay, let's say now the market value is 90 cents. Okay, and then your option price here or exercise price here is 1 ringgit. So you're going to have a negative of 0.1. Negative of 0.1, we consider this one as a 0 because we're not going to exercise the option, because if you exercise the option, you need to pay 1 ringgit, but the market value is only 90 cents. So we're going to have a loss. Okay, an option is said to be in money. So in money here, if when it has a positive intrinsic value. So once you have a positive intrinsic value, you call that, okay, you're going to have the in the money, positive intrinsic value. Then you're going to have in the money. Positive here means that when the market value of shares or market value of asset here is higher than the price of options. The price of options, option price. Okay, then said that you're going to have the in value and you have the positive value. The time value of an option is the expectation that the market or value of asset will change over the time during the option terms, and it will cause an option to become in money. So normally for the time value is given. Okay, in the examples here, we just follow the first examples here. ABC exposed to the price fluctuation due to the commitment to purchase of palm oil. So ABC purchase a call options here. Call options here is options to buy. Options to buy. Okay, to purchase palm oil with a strike price of 1720. So you want to buy that one at price of 1720. Okay, in order to hedge against the price fluctuation risk, as the current market price of the oil palm is 2010. Okay, the current market price is 2010. Okay, market value is 2010. But turns the call option is in money. Why is it in money here? Because your market value is higher. So when you calculate the intrinsic value here, market value here is 2010. So 2010, and then the strike price here is 1720. So you have a positive value. Positive value here is said that is in the option is in the money. Therefore, the ABC is going to exercise the call option to purchase the palm oil at the price of 1720. Even though the market value is 2010, but you're able to buy that one at the price of 1720 because you already entered the options. You already bought the option saying that I'm going to buy that palm oil at the price of 1720. So in this case, you're going to have a profit here because you pay less than the market value. Okay. And then the other ones, you have a swap. Swap here is a contract between two parties to exchange for the cash flow. So it's normally related with the interest rate swap. I'm not going to focus on the swap. We just focus on the forward, future, and then the other one is the options. Up to this one, any questions that you have here? So any of you have any questions before we proceed to the hedging here, please? So you understand this one? Okay, so far okay. Okay, we're going to proceed with the hedging. Okay. Okay, so we're going to look at for the hedgings here. Okay, for the hedging set, you accounting for derivative, we are done about this one. So we're going to look at here. Accounting for derivative. Okay, we're not going to discuss about this. Okay, the fundamental requirement for accounting is that derivatives must be reported on the statements of financial position. So once you want to report your derivative here, in the statements of financial positions here, it should be at fair value. So either you have the assets or liability here, should be reported at fair value. Derivatives are reported as an asset when they have a positive value. Positive value, then report at a as an asset, and then they're going to report as a liability when they have a negative value. The fair value of as a fair value of derivative can change over time, there is a need for adjustment to the carrying value of the assets and liability. So when there is a changes in the fair value of derivative here, we need to make a adjustment for the carrying carrying value. This adjustment will require the recognitions of gain and loss. Okay, if the use of derivative instrument for speculation purpose, for speculation here means not for the hedging, any gain or losses should be recognized in P&L. So speculation here is any gain or loss should be recognized in P&L. But if we use it for the hedging purpose, okay, any gain or loss would be recorded based on the type of the hedge used. Okay, if you use a fair value hedge, then we're going to have the gain or loss here going to be transferred to income statement of P&L. But if you use a cash flow hedging, gain or loss here will be transferred to others comprehensive income. Okay, so assume Enco purchase options for speculation. Okay, this one is for speculation. Speculations here. So gain or loss here be transferred to income statements here. Okay. On 1st of May 2019, it's entered into a call option contract. So this one you have a call options contract. So call option here is options to buy. Okay, to purchase 1,000 Bermuda share at the price of 15 ringgit. So the start price or the exercise price, okay, is 15 ringgit. So, okay, and then it's paid 200 here. Okay, on this date. Okay, on this date, the Bermuda shares for trading is also 15 ringgit. So in this date, the intrinsic value here will be 0. Okay, equal to 0 because market value minus the exercise price here, 15 minus 15 here is equal to 0. So you pay 200, the amount of 200 here, the premium of 200. Okay, so remember that for premiums you have intrinsic value. We already calculated that intrinsic value is 0. So the time value that you're going to have here is 200. The total amount of 200 here is regarded as your time value. Okay, the call option will be expired on 31st of July. Okay, if the price of Bermuda shares, okay, is above 15, the option here is in the money. So if the price is above 15, okay, if the market value is more than 15, then we said that option is in the money. Okay, in the money. Okay, and then the option is the money, and the AMCO can exercise the option, so they can exercise the options. Okay, exercise. Okay, but it said that if the option is worthless, if the price of the Bermuda share is less than 50, if the market value is lower than 50, then it say that out of money. So we do not do the exercises. It's not worth to exercise that one. Okay, so this is the information regarding the call options. Okay, so you have here the Bermuda shares. Okay, going to look at here. Okay, we just put it here because we want to use this one later. Okay, on 30 of June here, the market value of shares is 19. Okay, and then on 10 of July here, the market value become 18. Yeah? So at the beginning, on first when you sign on 31st July, when you sign the contract, okay, the options that you bought here on 1st of May, okay, on 1st of May. Okay, on 1st of May, the value that you have here, on 1st of May, the value here is 15. Okay, the market value is 15. Okay, and then the options, okay, the options you have here, the time value, okay, the time value, here you have 200 here at the beginning, now it become 90, and then it become 0. So this is how we have. This one is an increase by 4, this one is reduced by 1. This one is reduced by 110, this one is reducing by 90. So this is what we have. Okay, now we're going to prepare the journal entries. Okay, so the journal entry, the first one is to record for the purchase of the option. So you just debit the call options and then credit the cash. So remember that at this date, all the value of the options here is a time value because the intrinsic value here is 0. So all the amount of the premiums here is regarded as a time value. Yeah? Okay. So debit the call options and then credit cash. Okay, on 30th of June, on 30th of June, MCO prepare the financial statement and required to report the call options at the fair value. On this date, the price of the Bermuda share increased to 19. So the intrinsic value become 4 ringgit. It changes here, become 4 ringgit here. That 4 ringgit need to time with 1,000. So you have 4,000 here. So you're going to prepare the journal entries here to record for the intrinsic value. So debit the call options and then credit the gains on call option. This one for the intrinsic value. The intrinsic value has a positive here because there is an increase in market value. So debit call options and then credit gains here. The gains here will be transferred to your income statements. Okay, at the same time, the value of your times options has been reduced from 200 to 90. So the value here, so you're going to have a loss here, loss on the call option and then credit the call option. This one is to record from the value of time value, decreased by 100 here. Because you have here is 200 minus 90, so you have 110. Okay, so you're going to debit loss on the call options and then credit the call options of 110. Okay, therefore, at 30th of June 2019, AMCO is going to report for the call option at the fair value of 4090. Where to get that one? So look at your call options here. Okay, for your call options, here the journal entry, you start with the 200s. Now the amount increased by 4,000 due to the intrinsic value. And then the time value, so the time value was reduced by 110. So at the end you have a balance of 4090. So this is what you have. So on 30th of June, they're going to report the call option at the price of 4090. Okay, and then on 10th of July, the call option position is closed and net settled. Okay, we'll test that one. To record the settlement, first MCO need to update the value of the option. Okay, the first one, you need to update the value of the options. And then the intrinsic value of the call options here on this date become 3,000 because you have here 18 minus 15 here is times 1,000. A decrease by 1,000. The decrease in the time value here will be 90. Okay, now we're going to look at here. This is already combined. Like the one that you prepared last time, you're going to prepare two journal entry. One is for the intrinsic value. If you look at here, the intrinsic value, we start with the 19. 19 here is the price on 30th of June. Now it become on 10th of July, the price become 18. So reduced by 1 cent. Okay, so just prepare the journal entry, debit the loss on call option, okay, and then credit for options. Loss on call options, debit this one call options, and then credit the call options at 1,000. Okay, 1,000. This one is to record for the intrinsic value. The next one is to record for time value. Time value also have a loss by 90, loss on call option, okay, of 90, and then credit the call options of 90. Okay. Okay, when you combine these two journal entry, you're going to have a loss of 1090, which is 1,000 plus another 90. And then credit your call option. Okay, the one that you have here is already combined that two journal entries. Okay, so we're going to record for the settlements here. Okay, the settlements that you have here, you need to look at the balance of your call option. Okay, the balance of your call options here, again, you prepare the call options account. Okay, you start with the 200. Then you have increase in value by 4,000. Okay, this one is on 30th of June. Okay, and then you have a reducing on 30th of June. You have a reducing by 110 because of the time value. And then on 10th of July, we have a reducing by 1000 due to the reduce in the intrinsic value. And then for the time value, we have a reducing another 90. Yeah? So at the end, you have a balance of 3,000. So, okay, we have a balance. Okay, this one you total up, you have 4,200 here. Okay, 4,200. And then for that credit side, you have here, if you total up, you have 1,200. So means that you still have a balance of 3,000. 3,000 a debit side. Yeah? So a debit side, when you want to close here means that you need to credit. To close it means that you have to credit. So you're going to credit the call options and then debit the cash. So you're going to receive, because your call options still have a balance of positive balance, a debit balance. So debit balance here means that this is your asset. So once you want to close here, you're going to credit your asset. So you're going to receive a cash of 3,000. Okay. So up to this one, any questions that you have for the option? This one is for the purpose of speculations. A little bit different from what we have done for the exercise last time. Last time exercise here is a put options. Okay, this one is a call options for a derivative here. We don't have the H items here. Okay. Any questions that you have here? Before we proceed to the hedging accounting, any questions that you have here? Okay, I'm waiting if you have any question. Okay. Okay. So no questions, sir? Okay, wait for a few minutes. It's something settle here. Okay. If you have any question. Okay, now we want to proceed for the H accounting. Okay, for the hedge accounting here is the use of derivative instrument may help company to hedge against their financial risk. Okay, the objective of the hedge accounting is to present in the financial statement the effect of risk management. Yeah, we're going to present the effect of risk management. We're going to manage our risk here by using a derivative instrument. Financial risks that the company are exposed to that affect the profit and loss and others comprehensive income. Yeah? So the hedging accounting enable company to recognize gain or loss of both hedging instrument and hedge item in the P&L or others comprehensive income in the same accounting period. So you're going to recognize gain or loss for both hedging item and hedging instrument in P&L or others comprehensive income in the same periods, accounting periods. The hedging instrument is derivative whose fair value will affect the changes in the fair value of the cash flow. So the value of the hedge instruments here is depends on the value of the is going to be offset the changes in the fair value of the hedge items. So we use hedge instruments, okay, hedge instrument to offset, okay, changes in each items. Changes here is referred to the changes and of fair value or cash flow of the each items. Okay, and then the H items here is your assets, liability or unrecognized on commitment. Yeah? Okay, without the hedging accounting, there will be a volatility in the statements of comprehensive income as gain or loss of hedging instrument and hedge items are accounted separately under an FRAKF. If there is without the hedging accounting, we're going to account for the hedge item and hedge instrument separately. Okay, separately. But if you use the hedging item, the hedging accounting, you can offset the changes in the value of the hedge item using the hedge instruments. But the use of the hedge accounting here is optional. So it's optional, so it's not necessarily the company want to have that one or not. So, okay, so we have three types of the hedgings that we have here. Okay, for the first one, we have the fair value hedge. Okay, for fair value hedge here is a hedge in the exposure to the changes in the fair value of the recognized asset. Okay, that would affect the profit and loss, assets or liability or unrecognized commitment. Changes in the interest rate, foreign exchange rate, and commodity price is example of financial risks that affect the fair value of the hedge items. In the fair value hedge, changes in the fair value of hedge item are recognized in P&L, and then the hedge instrument is measured at fair value, and then the changes on the fair value of the hedging instrument also going to be recognized in the hedge item. So we're going to look at here changes in fair value of hedge item, okay, and changes in the fair value of hedge instruments here. Okay, going to be transferred to P&L. The both of changes are going to be transferred to the income statement. Okay, another ones you have a cash flow hedging. Okay, for cash flow hedging, okay, okay, for the cash flow hedging here is the hedge of exposure into the volatility on the cash flow. We're going to look at the changes of the cash flow of the recognized assets or liability of highly probable forecast transaction that will affect the P&L. The cash flow might relate to the future interest payment of receipt and the forecast sales or purchase in a foreign currency. In the cash flow hedge, the hedging instrument is measured at fair value. Okay, hedging instrument is measured at fair value, and changes in the fair value of a hedging instrument is recognized in others comprehensive income. Okay, hedging instrument and are accumulated in equity. So we recognize it in others comprehensive income. This one is in your income statement. And then after from the others comprehensive income, we're going to transfer to accumulated others comprehensive income. This is item in your statements of financial positions. The accumulated uh, the accumulated gain or loss in the equity are reclassified to P&L in the same period that the hedged future cash flow affect the profit or loss. And then if you have a sales here, then we're going to transfer from accumulated others comprehensive income to income statement using the GOGS account. So once you sell it, for example, say for the cash flow hedge, a forecast transaction that result in the recognitions of non-financial items such as fixed asset or inventory, the carrying value of the fixed asset or inventory is adjusted for the accumulated gain or loss in the recognized or loss recognized in equity. So gain or loss make to be adjusted. The value of the fixed assets or inventory is adjusted for the accumulated gain or loss recognized in the equity. Okay, here's for the net investments in the foreign operations. Okay, to hedge, this one is hedging related with the entity when they has a foreign operations. Means that we have a branch outside countries. Branch. Okay, outside Malaysia. Let's say you are a Malaysian company, but you have a branch outside Malaysia. So the entity are exposed for the foreign currency risk is required to translate. To translate here means that this branch prepare their financial statements. They prepare the financial statement. Then you need to, let's say this financial statements is using the Singapore dollar. Okay, Singapore dollar. So at the end of the year, once you want to combine the financial statement, parents and subsidiary, they need to translate the foreign operation which is in a Singapore dollar to Malaysian ringgit. So this one we call as a translate. To translate that one, the foreign operation into the entity financial currency. Translate it to Malaysian ringgit. Yeah? Okay. So foreign exchange gain or loss result from the transaction of the net asset are deferred in the equity until the foreign operation is closed. Okay. Changes in the fair value of the hedging instrument are recognized in others comprehensive income and also in a accumulated in equity. The accumulated gain or loss are reclassified to P&L when the foreign operation is a disposal. So the same as a cash flow here, gain or loss here will be transferred to others comprehensive income and then after that transfer to accumulated others comprehensive income. Same as the one that you have for the cash flow hedging. Okay, so we're going to discuss about the focus on the discussion of fair value hedge and the cash flow hedge, because the topics of net investments here will be in for 4 next semester. Okay, so we're going to look at the fair value here. Okay, the fair value here, you look at the example for Tasso. Okay, Tasso has 5,000 tons of palm oil inventory. Okay, they have these inventories here. They have the items here. Okay, they have the inventories. Okay, okay, you have that inventory. You have the assets. Okay, carry at cost of 1940. Okay, carrying at the cost of 1940. Okay, at 1st of June 2019. The palm oil inventory is to be sold on 31st August 2019. In the view of volatility in the palm oil price on the 1st of June 2019, Tasso entered into a net settled palm oil forward contract. Okay, now you enter a forward contract here to sell. Okay, forward contracts here to sell at the price of at the price of 1990. Okay, on 31st August 2020. You want to sell that one, to sell at 31st August at this price. Okay, and then you enter a forward contract on 1st of June. Okay, a forward contract on 1st of June. Okay, this is what you have on the forward price, the palm oil forward price. So this is the forward price, the forward contract price. And then the other ones you have here is for the other ones that you have here is this one is palm oil spot price. Palm oil spot price here is your inventory, say inventory of palm oil, the value of your palm oil. Okay, this one is the price for a forward contract. Okay, said that you want to this one you want to sow the palm oil at the price of 1990. If you look at for the forward contracts here, the price has been increased. So you look at here, the price increase here, how much you have here, the difference here you have 60. The difference that we have here is 40. So the price increase here. So when the price increase here, what it says that you're going to sell. Okay, going to sell that one at the price of that 1990. Okay, Tasso settled the palm oil forward contract and sell 5,000 tons of palm oil at the price of 2090. Just delete 10. Okay, 2090, which is the price that we have, price for the palm oil. Okay, on 31st August 2019. It prepared the interim financial statement on 30th of June. Okay, annual interest rate here is 12%. The following is the general interest rate. Given here, annual interest rate here, the purpose of given here is because we need for the forward contract, we need to calculate for the present value. So the present value, if you look at here, the interest given here is 12% per year. So divide by 12. So 1% will be your monthly interest. So monthly interest, when you want to refer to the table, you use a PV table, 1%. 1%. 1%. Then and here it depends on the month. So and here is a month. Because we already convert the interest into 1% based on the monthly here. Okay, so the first one that we have here, okay, we're going to prepare the interim financial reporting on 30th of June. So, this is your reporting date, this is your initial recognition date, and then this is your settlement date. Okay, we have 3 dates here. Okay, now assume that TASO does not apply hedging accounting. Okay. Okay, so don't apply for hedging accounting means that if you don't apply for the hedging accounting, you're going to prepare, we're going to account separately. One is for the forward contract, okay, and then the other ones you're going to have the for inventory of a palm oil. Okay, so you're going to have two different accounts here. One is for the forward contract, and then the other one is for the inventory of the palm oil. Yeah? Okay, at the date when you sign the agreements, okay, when you sign the or you enter the forward contracts here, there is no journal entry on that 1st of June 2019 as the fair value of the palm oil forward contract is 0. Because when you sign the contract, you said that forward contract, you want to sell that one at 1990. If you look at the forward contract price on 1st of June, 1st of June, isn't it? Let's see that. Here, the 1st of June, the forward contract on the 1st of June here is also at 1990. So also at 1990. So in this case, the value here will be 0. So when the value is 0 means that there is no initial outlay, so there will be no journal entry, but you need to provide a memo. Just provide a memo. Okay, and then on the 30th of June, okay, the 30th of June, what we have here, okay, on 30th of June, TASO prepare the financial statement and then to record the following journal entries. On 30th of June, okay, if you look at here, the value of your forward contract at 1st of June, okay, is 1990. Okay, 1990. Now the value become 2050. Okay, the value become 2050. Okay, 2050, the difference that you have here is 60. Okay, 60 here. If you look at here, your forward contract has a value of 990, but the market value here become 2050. You want to sell at this amount, so the price has been increased, so you're going to have a loss. Okay, because there is an increase in the price. So when there is an increase in the price, you're going to have a loss. The amount of loss that you have here is a 60 times with 5,000. So times with 5,000. So you're going to have here is 300,000. So 300,000. Okay, this 300,000 you need to present value that amount. We cannot use that 300,000. You need to present value that amount. So the present value of that amount here, that 3,000, the present value, your R here is 1%, and then your N here is 2 months. 2 months here is from 30th of June until 31st of August. So you only need for 2 months. So the rates here is based on the tables that you have here is 0.984. So you have loss on a forward contract 294, and then credit of forward contracts here is 294. Okay, that one is for the 30th of June. So I just finished this one. If you have a question, sit down your answer on this one. Okay, and then again on 31st August, they so report the settlements of the palm oil forward contract and the sales of the palm oil. Okay, on 31st of August, okay, the 31st of August, the value become 2090. Okay, the value become 2090. So increase, if you look at here, the difference that you increase here is 40. Yeah? 40 times 5,000, so you have 200. So during this time, the present value, the I here is, the interest here is 1%, but now the I here will be 0. The N here, the period here will be 0 because now you are at the maturity date. So the T here will be 0. The period should be 0. So when T is 0, this one is equals to 1. Yeah? So you don't have the present value that amount. So you're going to have here 200, debit loss on the forward contract, and then credit a forward contract. Yeah? Okay. So now you look at the amount of your forward contract. Okay, the amount of forward contract that you have here, you start with a loss of 494. At the beginning, you have a loss of 294. Okay, this one is on 30th of June. And then on 31st of August, you have another loss of 200. So the total that you have here is 494. So you're going to debit. Now you want to settle. This one is to record for the, this one is record the reducing in value. This one is to record for the settlements. Yeah? This one is for settlement. Okay, for settlements means that you need to close your forward contract. Your forward contract has a credit balance 494. So you need to debit this one. So debit a forward contract and then credit cash by 494. Okay, and then you sold your inventory on that date. You sold your inventory. So when you sold the inventories here, okay, sold your inventory, you're going to debit cash. Okay, cash you're going to receive here 10,450, and then credit sales of 10,450 for the sales here. Sales that we are using here is the price that you have on 31st of August. This is a price of the price, this is a price of spot price of the palm oil. So you are using the spot price of palm oil. Okay. And then your COGS that you have here is 9.7. 9.7 here is come from the, at the beginning it said that this one is the statements given here. Assume that Tasso has 5,000 tons of palm oil inventory carried at 1950. 1950 times with 5,000. So once you want to source your inventory, so you need to debit your COGS and then credit your inventory. Yeah? Okay, so this is what you have here. Okay, so this is what you have. Okay, and then this one is without hedging. Yeah? Without the hedging activities, we only account for the forward contract, and then the accounts for the inventory sales is only occurred when you sell the inventories. So we only have the changes in the value of the price of palm oil. We don't consider this one. No, that one, if because we don't enter the hedging accounting. Yeah? Okay, so once you have the example for the second, I just finished this one. If you have any questions later on. The second example here, the same information, but this time we apply the hedging accounting. Okay, so when we apply for the hedging accounting, every date, we need to account for the changes in the value of each item and also changes in the value of each instrument. Yeah? So every transaction date, you need to account for these two. Yeah? Changes in the value of the each item. So this one we refer to the spot price of the oil pump. Okay, oil pump. This one we refer to the price for forward contract. Yeah? Okay, the each instruments. Okay, on the 1st June, there is no journal entries here because the contract price, the forward price is 0. The fair value of the palm oil of the contract price is 0 because the value is similar, the spot price, and the value of the forward contract is similar, so it will be 0 there. Okay, and then on 30th of June, so the 30th of June, the first one, you need to prepare two journal entry. Okay, the first journal entry is for the hedging instrument. This is the hedging instrument. You prepare the hedging instrument first because the same thing like the one that you have previously. Loss on a forward contract and then credit a forward contract. And then the next one, the next journal entry, you prepare for the hedge item. So the hedge item set is related with your inventory of palm oil, palm oil inventory. Okay, the palm oil inventory, you need to look at the spot price of the palm oil. Okay, refer to the spot price of palm oil. Okay, the spot price of the palm oil on 30th of June, the price is 2,000 compared with the price on 1st of June. This 20 is a price of spot price of the palm oil at 30th of June, then compare with the 1st of June. So 30th of June, you have the value here is 2,000 and then this one is a value is 1950 and then time with 5,002. So you have 250. So debit your inventory and then credit your gains on the revaluations of inventory. Your value of inventory has been increased. Okay. Okay. On 31st August, okay, if you look at here, when you have hedging accounting, you're going to have two journal entry. One is for the hedge instrument and then the other one is for the hedge items. Okay, and then on 31st August, you make a settlement. Before you make a settlement, you need to record the, okay, before a settlement, we need to record for the changes in value. Okay, we need to record for the changes in value. Okay, before settlements, we need to record for changes in the value of each instrument and also each items. Okay, for your hedge instruments here is a forward contract. The forward contract that you have here, the value here will be 2090. 2090 is a value on 31st August. 31st August, this is a value on 30th of June. So it means that there is an increase by 40 here. Increase by 40 here means that you're going to have a loss. You're going to have a loss because you enter the contract at the price which is lower than the market value. Right? So you're going to debit a loss again and then forward contract 200. Okay, and then the second journal entry, you need to prepare for the changes in the value of your inventory. So the value of your inventory on 31st August, the value here is 2090. And then on 30th of June here, on 30th of June, the value is only 2000. So increase in the value of your inventory here means that you're going to have a gain here. Because this is the value of your inventory have been increased. But in terms of your contract, you have a loss here because the increase in the market price is higher than the contract price. So you're going to have a loss here. So the inventory that you have here is 450 and then credit the gains here is 450. Okay, when you total up here, your forward contract has amount of 294 and then plus another 200. Both of this one has a loss. So loss means that you have a liability here. So a liability is a credit side. Once you want to close it, or close here means that you have settled, you need to debit. So debit your forward contract of palm oil 494 and then credit cash of 494. Okay, and then the sales of your inventory. Okay, the sales of your inventory here, debit cash and then credit sale at the price of the price at the 31st of August here is 2090. The 2090 times with 5000, so you have 10,454. Okay, your cost of inventories here, the cost of inventories has been increased. This one is at the 1st of June. This one is the cost of for 1st of June at the price of 1940. This one is increasing in the value of your inventory on 30th of June. And then this is another increase in the value of your inventory here is on 31st of August. If you look at here now, the value of your inventory become 10400. 10400 due to the increments here. Okay, so any questions that you have for this one? Any questions for this one, for the fair value hedging? Okay, I'm waiting for you if you have any questions. Any question for the fair value? Do you have any questions here? Okay, so we're going to proceed. No questions for the fair value. So we proceed with the cash flow hedging. Okay, cash flow hedging is a little bit complicated for these examples. Okay, so we try to protect that one fully. Okay, so for the cash flow hedging here, the one that you have here, okay, is a forward contract. Example of a forward contract. Okay, Jerai Company Berhad is a Malaysian company that manufactures cooking oil using palm oil. Okay, they manufacture cooking oil using palm oil. Okay, it's prepared interim financial statement on 30th of June. So reporting dates, you have two reporting dates here, 30th of June and also on 31st December. The company risk management objective and strategy is to hedge the palm oil risk, okay, based on the expected consumption up to the 12 months before the delivery. Based on the production plan for the first quarter 2020, it is estimated that the palm oil consumption will be 10,000 tons. Okay, in line with the risk management objective and strategy, on 1st of April 2019, the company entered into net settle palm oil contract, forward contract to purchase 10,000 tons on 31st January 2020. So you're going to enter the contract here. This is your contract date. Okay, initial recognition date. Okay, this is your reporting date. And then this is your maturity dates. So we have here the contract here is in US dollar, USD. Okay, the contracts that you have here is for 512. Okay, and then 507, and then you have 525, and then another one you have 53. This is the price of the forward price, the forward price, and the rates for that in terms of the US dollar to Malaysian ringgit here. We need to know this one because we need to convert that one into a Malaysian ringgit. Okay, just put here because we want to use this one here. Okay, the forward price. Okay, the forward price on 1st of April, the value here is 512. Okay, and then this one we have 507. This one is 525. And then the last one we have 581. Okay, so this is what we have in terms of the forward contract. Yeah? Okay. On 1st of May, the company ordered 10,000 tons of palm oil to be delivered on 31st of January 2020. The order in May, the price is based on the spot price at the delivery date. So the price that you're going to pay here is based on this price. Wait, let's see. Okay, the company is able to demonstrate that all the requirements for hedging accounting as required for MFRS 9 financial instrument are met. Means that you already have each item, each instrument, already have the contract and hedge effectiveness. So we assume that this hedge is a cash flow hedging. Yeah? Okay, so now we're going to prepare the journal entry. So for the journal entry, the first one on 1st of April, no journal entry required because the fair value of the palm oil forward contract is 0 because the fair value is equal to the forward contract's value. Yeah? So now we look at on 30th of June. Okay, on 30th of June, if you look at here, the price has been increased. Yeah? Sorry, the price has been reduced. Okay, we start with 502. Sorry, 510. What I'm talking about. 512. Okay, this is the price on 1st of April. Now the price is reduced to 507. Okay, when the price is reduced here, so you are in the, okay, when the price is reduced here, so you have here, the price reduced that you have here, the difference that you have here is equals to 5. Yeah? Okay, the difference here is equals to 5. Okay, so when the price is reduced here, the amount that you have here is 50. Yeah? 55 here, we'll look at that one. 5 here times with 5, how many one that you want to buy here is 10,000. Yeah? Okay, your contract price here is 512. This is your contract price. Okay, and then now the market value is 507. So reducing in the market value means that you're going to have a loss. Going to have a loss because there is a reducing in the market value. How much the loss that you have here? The loss that you have here is 50,000. That 50,000 is in the US dollar. Yeah? Okay, so you need to find the present value. So the present value that you have here is for 7 months. So the interest rate that you have here is 12%. So 12% is per year. So divide by 12 years, so you're going to have only 1%. Yeah? So if you want to use the tables here, we are using this one 1%. And then your ends here, the ends that we have here is from the dates. When is the date that you have here? Is on 30th of June until the maturity date here is on 31st of January. So you're going to have here it's a 7 months. 7 months. So this is what you have for 7 months. So the 7 months that you have here based on the tables given here is 0.923. So you time with 50,000. So in terms of loss that you have after the present value, the amount of loss here is 46,650. And then this 46 you need to convert to Malaysian ringgit. Okay, once you convert to Malaysian ringgit, the rate on 30th of June, okay, the rate on 30th of June here is 405. So 405 times with 46. Okay, so you're going to have a loss here in terms of Malaysian ringgit here is only 188. Yeah, 188,932.50. So you prepare the journal entries here. Okay, debit your cash flow, H reserve, others comprehensive income, and then credit your forward contract. Cash flow, H reserve here is a debit because you have a loss. Why you have a loss here? Your contract price here is 512, but now the market value of the H items of the palm oil here is only 507. Your contract price is higher than, okay, your contract price is higher than market value, so you're going to have a loss. Okay, so that is what we have on the 30th of June. Okay, the next one we look at on 31st December. Okay, the 31st December, again, you need to find a new value, the new value of your palm oil here. Okay, the new value that you have here, you need to look at from the forward contract. The forward contract, the value that you have here is 4512. Okay, now when it comes to 31st December, the value become, what will be the value on 31st December? The value become 525. Yeah, 525. Okay, how much the difference that you have here? The difference that you have here is 5 to 5. Select 5 to 5, so you have a difference here by 13. 13 here is increase in value. So increase in the value here means that you're going to have a profit. Yeah, going to have a profit because your contract price here is 512, but now the market price, because you are going to buy, so the market price is only 525, means that the market price is higher than the contract price, so you're going to have a gains. Yeah? Okay, the difference here is 13. The 13 times with 10,000 here, so you're going to have here is 130. Yeah? So 130. Now you need to present value that amount. So you need to present value. The increase in the value that you have here is 130 minus 50 minus loss 50. If you look at here from 1st of when the date is okay, 1st of April until 30 of June, you have a loss of 50, loss negative, negative 50 because you have a loss. Okay, and then from 1st of June, so 1st of April until 31st of December, okay, 31st of, sorry, from June, 30th of June until 31st of December, you have a gains of 130. So you want to find the difference here. And to find the difference here is 130 minus 50. So you're going to have here, you're going to be 130 plus 50. So you're going to have a gains of 150. Okay, that 150 need to present value. Need to present value here. The present value here is from 31st of December until 31st of January. So you only have 1 month. So the rate for 1 month is 0.99. So 180 times 0.99. So you have here in terms of USD, you have 178,200, and then the rate during 31st December here is 412. Time this one with 412, so you're going to have 3734,184. This is your gain. Yeah? Okay, so the journal entry that we have here, debit a forward contract and then credit your cash flow reserve, others comprehensive income. So this time we have a gains. Okay, I just proceed. If you have a question, I'll let some time for you to ask a question. So I just finish this one first. Okay, on 31st of January, okay, on 31st January, the fair value of the palm oil forward, okay, what will be the fair values here? The fair value of the palm oil forwards now become 530, yeah? Okay, 530. Okay, as compared with the 512, okay, from 512 to 530, so that you have an increment that we have here is how much you have 18, isn't it? Okay, you have an increase by 18, so 18 increased by 18, so the amount that increase in 18 means that you're going to have again, so this amount need to time with 10,000, so you're going to have here is 180,000 time the 18 string US dollar time with 10,000, so you're going to have hundreds of 80. Yeah? Okay, increase in the fair value. So increase in the fair value, if you look at here, the fair value on 31st December here, you have a gain of 130. And then on 31st of January, you have a gains of 180. Yeah? So the changes in the value here is only 50. That is what we have. The difference here is 50. So this 50 need to time with the rates at the exchange rate not on 31st December is supposed to be changed this one on 31st of January. The exchange rate here is 4 ringgit and 70 cents. So you're going to have here is equals to 208,500. Okay, so the total profit when entering the palm oil contract here will be 753. 753 here is the first one, you have a loss. Okay, on 30th of June, you have a loss. Okay, and then plus a gain that you have on 31st December. This one, the gain that you have on 31st December, and then the gain that you have on 31st of January. So the total amount that you have here is a 753,751. So you're going to have gain, which is your gains here is higher than your loss. So you're going to have a forward contract as your assets. Forward contract as your asset. So to record for the settlements here, yeah. Okay, so this is what you have forward contract. The gains that you have here 208,500, and then this one is to record for. This one is to record for the changes in value. Okay, changes in value. Okay, this one is a record for the settlements. Okay, debit cash and then credit off forward contract of 753751. Okay, and then during that date you bought the inventory. So the inventory that you bought is at the rate during that time. So the rate during that time is 530 USD. And then this one need to time with 4 ringgit and 70. Okay, 10,000 here is the amount of your inventory. Time is USD and then time with Malaysian ringgit. So the amount of inventory that you bought here is 22,101 and then credit cash 22,101. Okay, and then it said that what you have at the end. It said that the cash flow hedge reserve have a credit balance of 753,751. Okay, 50. The amount to be reclassified to profit or loss as a reclassification adjustment during the period when the hedge expected future cash flow affect the profit or loss in accordance with the requirements of the MFRS 9. Yeah? So this one, the gains that you have here will be in the others comprehensive income. So when you prepare the statement of financial position, you're going to transfer to accumulated others comprehensive income. And then let's say you process the palm oil become the cooking oil. Okay, the cooking oil, you process it, become a cooking oil, and then you sell the cooking oil. Then once you sell, one that you have in accumulated others comprehensive income going to be transferred to income statement by if the effect here to your COGS accounts. So this is what you have. Okay, any questions that you have for the hedging, the cash flow hedging? Any questions? Which part that you think that you cannot understand? So the things that you may get confused here is once you want to calculate the gain or loss here. The gain or loss, you need to compare the forward contract with the value of the forward contract during that date. So means that the forward contract that you enter here is at 512. So you're going to compare that 512 with the rate at the difference dates here. Okay, we cannot compare between, let's say 30 January, you compare to 31st December. No, you cannot do that one. Because the contract here, we enter the contract saying that we're going to buy at the price of 512. Okay. So any questions that you have for a forward contracts? Okay. Any questions that you have here before we proceed to the last example that you have in the notes on the options here? Options here is a little bit confusing. We'll try to look at that one. Okay, say let's you about 3 minutes to look at if you have any questions. Any questions? I'm still waiting for another 2 minutes. We're going to start example to by 12 here. Any of you have the questions? Okay, so clear about that one. Okay, so try to look at the last one. Okay, so we're going to look at the options. So clear about that one. So this one is a little bit confusing. I don't know how to explain the best thing to explain about this one. Okay, so we're going to look at the Exim manufacturers and sell. Okay, Exim manufactures and sell electric parts to a various customer. On 1st of December 2019, a customer in the US has agreed to purchase a good at a price of 500. Okay, going to buy that one at the price of 500. So they agree to buy. Customers agree to purchase goods, so means that you are in a position of selling. So delivery is scheduled on 1st of February 2020 and the payment is expected to be received in March 2020. To hedge the exposure to foreign exchange risk arising from the highly probable upside forecast, Exim purchased a foreign currency put options on 1st of December 2019. The put gives Exim the right to sell 500,000 USD at the price of 4 ringgit and 13. 4 ringgit and 13. Yeah? Okay, Exim pay a premium of 0.01 per dollar and 0.1 cents per dollar. The spot exchange rate on the 1st of December 2019 here is 4.13. Therefore, Exim pay 5,000 for the puts options here because the price is similar. Here, the spot exchange price is similar, so they need to pay for a premium. So the premium that they pay here is only 1 cent per 1 US dollar. Yeah? So the options, the premium, the put options that you have here is 5,000. The intrinsic value of the put option on 1st of December is 0. Okay, because during that time it's similar, so the intrinsic value will be 0 as the strike price, and the spot exchange rate is the same. Okay, the strike price that you have here, okay, the intrinsic value here is a market value and minus the strike price. Okay, the market value during that time is 4 ringgit and 30. The spot price here is also at 4 ringgit and 30. Yeah? Okay, the price for the put option is solely based on the time value. So the 5,000 here is for time value only. Yeah? The put option will be in money if the dollar depreciate and the spot exchange is less than 4 ringgit and 30. So it's the Malaysian ringgit. The spot exchange is lower than 4 ringgit and 13. It says that the one will be in money. Okay. If the spot exchange rates on 1st of March is less than strike price, the Exim going to exercise the put option to sell 500 at the strike price of 5 ringgit and 4 ringgit and 30. If the spot price is less than the strike price, then you're going to sell that one because you can sell more than the value of your options. Okay, so if you look at here, the spot rates that you have here on 1st of December here, the 1st of December, you have the value of 4 ringgit and 13. This one is at the contract date, at the date when you have the options. So this is your contract date. On 31st December here, the rates here become 409. 409 here is below than your exercise price. So below than exercise price is still okay. During this time it's still okay because this still the exchange rate is lower than. Okay, the exchange rate on 31st December we have 4 ringgit and 09, which is lower than the option price, which is 4 ringgit and 30. So this one is still in the money. Okay, if you look at here, the value here become 4 ringgit and 14. So come on 1st of February and also on the 1st of March, the value is higher than the price, the option price, the strike price. Okay, so it's not worth to exercise your option during this time. Yeah? So you look at here, the premiums that you have here is that 1 cent at the beginning. Now it increased to 48 cents and then reduced to another 5 cents. Then it becomes 0. Okay, the fair value of the options that you have here is 5. Okay, 5 here. And then the value of options here become 24. 24 here is 48 here. The one that you have 48. Okay, 48 that you have here done with, okay, what you have here 48 0.0 for its. Okay, so you're going to have 24. So now the value is 48. So time with 500 here. Okay, so with 500, so you're going to have 24,000. Okay, and then now the value of the options become only 5 cents here, reducing your 5 cents to become 5 cents times 500, so you have to link 2,500. And now the value become 0. The option premium becomes 0, so the fair value of the options here is 0 because now it's already out of money during that time. Yeah? Okay, so this is put options. The put options, the value that you have here, the fair value is come from here. Where to get this figure? The figure is come from here. Okay, so you have 5 here. So during the dates here, the time value has a 0 because sorry, you have the value where the value is come from here. The calculation is from here. Okay, and then you have on 1st of December, the value is 5. The value 5 is your premium, it's a premium that you paid during that time. And then for the intrinsic value is a 0 because during that time, your market value here is equal to your strike price. Okay, we're going to have here is 5. 5 for the time value. All the amount of premium 5,000 here will be allocated to the time value. Yeah? Okay. And then you look at here. If you look at here, and then you come the next one, you have 24,000. The 24,000 that you have here is from here. So increase in the value of 24,000 here. It's come from here. Okay, and then you're going to look at for the intrinsic value here. So the intrinsic value you have 20. Where does 20 come from? How you calculate that 20 come from? Where is that 20 come from? Okay, the 20 come from here is the one that you have here, 4.13 minus 4.09. Okay, so you're going to have here for the intrinsic value, just look at here. The one that you have here, the market value here is 409. 409 minus the one that you have here is 413. 413 is your exercise price. So you're going to have the difference here is 0.04. Then time with 500,000. So you're going to have 2,000. So during this time, your intrinsic value has a positive value. Has a positive value here because the price is reducing. Now you are in the positions of selling. Yeah, position of selling. So when the price is lower, we said that you can sell more than the value of the market. So you're going to have a profit of 20. So where to get this one is 0.04 times with 500. So you have 20. So from that 24, 20 is regard to the intrinsic value. So the difference is 4 for the time value. So the time value has a reducing by 1,000. Okay, and then we come here, we can look at the next one, the fair value options that you have here. Okay, the fair value options that you have here is 2,500. Okay, during this time, the price become 4 ringgit and 14. So 4 ringgit and 14 here, we're not going to exercise. 4 ringgit and 14 here is higher than 4 ringgit and 13. So 4 ringgit and 13 here is your strike price. So we said that when the market value is higher than the strike price, the intrinsic value here will be 0 because you're not going to exercise that one because it's going to have a loss. So that's why for the intrinsic value here, you're going to have a 0. So all the amount that you have 2,500 here will be transferred to the time value. Yeah, the time value because the intrinsic value here will be 0. If you look at here, the reducing that you have here is 1.5 here. Okay, and then on 1st of March here, okay, the fair value is 0. So the intrinsic value of also 0 because now on 1st of March, the market price is 4 ringgit and 20, which is higher than 4 ringgit and 30. So the intrinsic value here should be 0. So when the fair value is 0, the intrinsic value is 0. So the time value also 0. Since this one is reducing by 2,500. So just want to finish this one. If you have a question here, later on you ask a question. Okay, the first one, you're going to debit your put options at the date when you bought the put options and then credit cash. Okay, and then the other ones you're going to debit the foreign currency put options, and then this one is using the cash flow hedging at only the elements of the time value, and then the cash flow hedging for the time value elements here is 1000. 1000 here is from 5000, now the value become 4000 here. And then for the hedging elements for the intrinsic value, the value is 20,000. For total out for the totals that you have here is a 20 and 19. The one that you have for a time value here is 19. Okay, this is what you have for the cash flow. The intrinsic value 20, and then you have that one. Okay. So if you want to prepare that journal entry separately, you can prepare that one separately. Okay, the first one you account for intrinsic value. Okay, going to debit your each items. Okay, the one that you have here is each item. The one that you have here is 20, and then credit your gain. You have 20, and then gain on puts, and then you're going to have a puts here. Okay, and sorry, then you're going to have a loss here. Loss that you have here is 1, and then you're going to credit your puts here as 1. At the end, you're going to have the hedge element. The puts that you have here is the hedging elements. So you're going to have here is when you total up these two figures, you have 19 for this one. One is for the puts, and then the other one is for the intrinsics. Okay, so you have that one, the value of 20. Okay, the fair value that you have. Okay, and then on 1st of February, Exim deliver goods to the customer in the USD, and then record the receivable of 2070. 2070 is the rate at 1st of February, when you deliver goods. So you're going to, when you deliver goods, you're going to record your account receivable 2070, and then credit cash. Okay, and then on 1st of March, you receive the cash. Okay, so you receive the cash here. There is a changes in the price of your account receivable, because now the rate become 4 ringgit and 20 cent. So 4 ringgit and 20 cents. Now the rate become 4 ringgit and 20. If you look at here, the rate prior here is 4 ringgit and 14. So you have a changes here is 60 cents. 60, not 60 cents, 0.6. You're going to have 0.06. This one time with 500,000. So you're going to have gains of 30. Your account receivable has been increased by 30. So increase by 30, and then credit gain, and then cash that you're going to receive here is 21. 21 here is from 4 ringgit and 20 times with 500. So the amount of gain that you're going to receive here is 2.1 million. And then you're going to have a loss here, loss for the foreign operation, the put options that we have 5,000 here, because the amount is already out of money. So you need to reclassifications of the adjustment to P&L of 1,000, and then cash flow hedge time value of 1,000. And then for the hedging elements, the hedging elements that you have here is only for the hedge intrinsic value. You only do for the hedging here is only the intrinsic value. The time value is not the hedging. You just use the intrinsic value for the hedging purpose. So this one is quite complicated, because not the whole parts of the options price is used for the hedging. You only hedge for the intrinsic value. So that's why if you look at here, the one that you have here is 2,000 here, 20,000 here. This 20,000 here is only for the intrinsic value. Okay, this 20,000 second. Okay, if you look at here, this 20,000 here is only for the intrinsic value, because we only hedge for the intrinsic value only. This one is a little bit complicated, so maybe if you have time, we try to look at this one again. Need to understand this one, okay, because we only hedge over the intrinsic value. So it's much different from the one that you have in the previous example when we hedge for the whole amount of your option, intrinsic and the time value. So this is a little bit confusing here. Maybe we need a lot of time to discuss about this one. So any question relate with this options, we're going to discuss next class in detail. Okay, we're going to discuss this one once again in the next class for the hedging of option, because this one is a little bit different, because it hedge here and used for the hedging here, you're only hedging for the intrinsic value. Okay, you're only hedging for the intrinsic value. We don't hedge for the time value. Yeah, so this one is a little bit complicated. See, because which hedge here is only for the intrinsic value, not for the time value. Yeah? Okay, this one is not in, I cannot see this one in your example, so maybe we need some time to discuss. Okay, we need more time to discuss this one once again for the next class. Yeah? Because we know it's only already 12:15. Okay, for those who want to left the meeting, you can left that one. For those who have a question, except for the option, because the options we're going to discuss this one once again. Yeah? If you have a question relate with the fair value or relate with the cash flow, okay, still here waiting for you if you have any question. If not, we're going to bring this option for the next class, or maybe for the first half an hour. We discuss this one again, and then we're going to continue with the notes on a different text. So please check your online for the notes. Okay, for those who want to left the meeting, you can left the meeting. If not, okay, we're going to discuss that one for the next class. Okay, any questions that you have? Okay, so maybe next class we just continue with the option again, yeah? Because we need some time, more time to discuss on that. Okay. Okay, so thank you. No questions, sir? If you have any question, I'm still here. Sorry about the 1.5 hours. Okay, any of you who still have a questions, I can that one. I just want to stop this one. For those who want to leave the meeting, can leave now. Okay?
Madam,
Yes. Yeah. Anything?
I cannot upload my MC.
Sorry?
I cannot upload my MC in
Why?
OS.
What? You cannot use your OR? What about the rest? Why you can't upload that one? I haven't checked that one. Okay, due to what? Huh?
It,
Due to what? Problem with what? Okay, the rest. Hmm? Problem with what? Audrey said it can. Who's the ones? Vinita. Why you can't upload your CC? Mini case.
I,
Okay, can you
I
just
don't know.
email me? Can you just email?
Yeah, I can.
Okay. Just
Okay,
email
thank
me.
you, madam.
Okay.
Doctor, can I scan the attendance?
Okay. So no questions here. Let's stop sharing this. We have the attendance. Okay.